Hello, everyone. Welcome to Feedstuffs 365. I'm Sarah Muirhead. With us today is Richard Brock of Brock Associates. Welcome, Richard. Great to have you with us.
Good afternoon. Glad to be here.
For those of you that are tuning in, if you have any questions for Richard, you can post those there in the chat. If you're joining us from social media, you can post those directly in your social feed. So, a lot going on, Richard. You and I were talking here just before we went on, and you said it's not been a good week for the commodity markets, and I think there's just kind of all kinds of uncertainty out there in a lot of different regards. So,
Well, reality is it depends on what side of the market you're on. For some people, it's been a terrific week in the commodity markets. For others, it's been the opposite. No matter which way a commodity market goes, there's a winner on one side and a loser on the other. So, but I will just say this: it's been one of the biggest weeks I've seen in several years in the grain markets. We've seen some very, very major moves, and a lot of things going on politically. Of course, a lot is going on. I will stay away from that subject, but I think I'll fly through this very quickly,
okay.
and I think there will be a lot of questions. Obviously, we have a lot of turmoil going on. I'd like to make a few comments just on the general economy and farm economy. Even what has been going on, farm wealth is at an all-time new high. Debt to asset ratios are near the lowest in history. I'm talking about grain farms here. Farm size has accelerated at an unprecedented rate. What we're seeing happen now is a similar transition that we went through in 1986 to 1987. Most viewers are probably too young to remember that, but it was after a long bear market and there was a lot of financial stress, and we saw some very, very big changes take place. We obviously will touch on the tariffs and downsizing of government, but that one I won't spend much time on, but tariffs are somewhat significant here. All eyes are on China, have been for a long time. We take a look at the wealth that's concentrated there in the major cities. The rural areas are poverty stricken. Investments are being pulled out of China at a fairly rapid rate. We take a look at the percent of GDP just to give everybody a scope of the big picture. We account still for 25% of the world's GDP. Europe is 17%, China is 17%. Here's another graphic look at it. Here's where we are and what the trend has been since 2012. The U.S. is here. This was the whole world. Here's Europe, and here's China. And you can see they're still a good ways behind us. This is a chart that shows the investments in China. You know, we're not the only country in the world that blames China for the COVID outbreak. And so a lot of companies and countries from around the world have pulled money out of the investments. The money is coming out, not going in. You can see back here where we were in 1998, 99, and here's where we're at right now. You take a look at your clothing labels, where it used to be 10 years ago, everything was made in China. Now you find a lot of the labels say, you know, made in Vietnam, made in Indonesia, a lot of other countries around the world right now. How quickly things can change. It's gone from Shanghai to Shanglo. We take a look at the ag exports to China. We're down pretty significantly, but nothing like we were in 2018. We take a look at the net global ag trade. We're down sharply, have been now for 2 years in a row. Basically, everything on the world ag trade, I want to show my political bias, but started to go to heck when Biden took office. Maybe not be all that administration's fault, but this is from a timing point of view. That's when our trade started to fall apart. Here's another way of looking at it, and I know we're all concerned about what's going on with Mexico and Canada. Here's China exports, and here is Canada and Mexico, both very key countries to us. What's interesting is we just had our own conference here in Destin, Florida, a little over a week ago. We had some Canadians here, and they're all concerned, and they're pretty much anti our government right now because they think the tariffs are going to hurt them significantly. And yet I said, you know, that may be the case, but if that were the case, the value of the Canadian dollar would be going down considerably. And the reality is Canadian dollar bottomed when Trump started putting the tariffs on, and it's come back very strongly. The currency is very strong. Then we take a look at the Mexican peso, and it's the same thing. The currency has been strong ever since the announcement of these tariffs. So the world and the investment community is looking at these tariffs in a more positive way than I think a lot of people in this country are looking at it. And I think the outcome will be better. Here's what's really hurt us in all of agriculture is Brazil. And this is a monthly chart going back several years. Earlier this last few weeks ago, we were making new 23-year lows in the value of the Brazilian real, which makes their commodities a lot cheaper than ours. And I'll show you in a couple charts later. I mean, they just really have taken over the world grain trade. A couple comments on oil and crude oil. I think, some of the verbiage that Trump says, we're going to become energy independent again, blah, blah, blah. Well, frankly, we've been energy independent since about 2021. This is our net exports right here. We have not been a net importer. We've been here's our exports, here's our imports. And so, this is probably going to get better and improve. But the reality is, we've been treading sideways in the oil industry here for the last 4 years. We take a look, we go back to 2017. We take a look at oil exports out of Iran. China was taking, 29% then? Now they're taking 91%. So the flow of oil around the world has changed more than dramatically. Take a few quick looks at the ag exports. Our number one export last year was soybeans, $24.5 billion compared to 27.7 the year before. It's down 32%. Take a look at corn exports, 13.9 billion. That was up 6. We take a look at beef exports, up 9.1. And while we talk about the pork exports, really since the main buy China had several years ago, pork exports rank fairly far down now, but they were up 8% last year. And this is what's also, I think, very significant to what we all have to deal with. Mexico accounts for 30% of our agricultural exports. Canada, 28%. China, 24.7%. So trade deals with Canada and Mexico are very, very important to everybody. All of us work with, and a lot of these other countries are important, but not near as important as the top three. And then you have Japan at 12%. This is also a very significant chart. These are government payments into agriculture. You go pre-COVID, and this is what goes mostly to farmers and to pork and poultry producers. The government was paying outlays of about $25 billion. Then during 2020, that shot up to almost $55 billion. And then here's where we were last year. And so now they haven't made these payments yet, but you see how it says the other supplemental and distress payments for agriculture. And right now they're dragging their feet and making these payments, but they are going to be made, and I think it's pretty sure, by the end of March. So there's going to be another big infusion of cash into grain and livestock farms in the United States within the next 4 weeks. I mean, this is really huge. I think it's $42.5 billion they've announced they're going to pay out here by the end of March. We take a look at the debt to equity and debt to asset ratios. We're down, but this is nothing crucial, really not much going on there. We take a look at where we are, what we call the 7 stages of the agricultural economic cycle. You can see back in 1985, we were down in this area. Some of us are old enough to remember that. Then we peaked in 2012, bottomed in 16, and then we peaked again in 2022, just 3 years ago. And we've been in a very sharp slide down, and this is primarily for the grain markets, corn, soybeans. And we think the market long-term is bottoming, although short-term, we do not feel that way at all. This has been a very big negative week. We take a look at a corn balance sheet, which is what ultimately determines the price of corn. Last year, we planted 95 million acres of corn, or we believe we're going to plant 95 million acres this year. Last year, we planted 90.6. In 23-24, we planted 94.6. So we're going to go back to where we were. Some people think we're going to be even more than that. But take a look at the numbers on the demand side. Feed usage of 5.8 versus 5.8 a year earlier. For the new crop, 5.85. We take a look at corn used for ethanol, 5.5. So we feed basically to pigs and chickens about the same amount of corn as we crush in ethanol plants. This year, exports are up. Exports have been quite strong, expecting now about 2.5 billion bushels of exports. That compares to 2.29 a year ago. The important number is the stocks to usage ratio for the last 45 years. If you can estimate that number in corn, it only works in corn, you should be able to estimate the average price of corn at the farm within 30 cents a bushel. And 9 years out of 10, that will work. And you can see our expected average price this year is in the high $4, almost $5. And the way you get to that number is relatively simple. If any of you have ever read a scatter diagram, you've got the on the horizontal axis is the stocks to usage ratio, and the average price of corn at the farms on the left side. This typically equates to a Central Illinois cash price. And then here's your price curve. So if you can estimate this number, which right now we're estimated about 11% for this year, you come over to the left-hand side of your vertical scale, and it shows a price of just under 480, or about 480, which is why we would estimate, give it a 30-cent range on either side. And again, you're going to be fairly accurate. You need to have a stocks to usage ratio under 9% to get the big bull markets like we had in 2012, 2011, 2010. And then once you get above 14%, you're looking at a flat market for a long time. Now, the biggest game changer in corn happened in January, and I've never seen this happen in my 49-year career in this business. But the USDA changed the corn yields from this past fall dramatically in one report, and I'll show that to you here in a minute. Here's the planted acres chart. Again, last year we planted 90.6. We think it's going to be back up to where it was a year ago, around 95 million. And this has been a real killer. We've gone from a 63% market share of corn exports since 2015 down to 33. Brazil has gone from 8 to 25% share. As Sarah and I were discussing before we started this Saturday, I do the outlook for the Southern Cotton Ginners Convention in Memphis. They're having several programs, or parts of programs over the 2 days on how we try to start getting our export demand back. I mean, the problem is everybody's, it's like trying to put a barn out after it's already halfway burned, or having the barn go on fire and say, gee, I need insurance. Yeah, well, it's a little bit too late. I mean, the time to start worrying about all this was 15 years ago. And I don't think we're going to get this market share back on the corn from Brazil. And the two fundamentals have changed a lot. Number one, which a lot of people don't want to talk about, is the selling of Syngenta to ChemChina and the selling of Monsanto to Bayer, all within the last 10 years. And prior to that, U.S. farmers were the only ones that had access to that genetics. Now that these are worldwide owned companies, a Brazilian farmer has access to the same genetics that a farmer in central Iowa has. So it's really changed things. And then, of course, the value of the currency declined in Brazil. And then the other factor is Brazil has a lot of land to bring into production that in the U.S., we're down to nothing. We have no land to really bring into production. Here's the production on a global size. You can see we produce about 377 million metric tons. China's at 294. Brazil's at 126. But here's the yield changes, and I'm sure people viewing this live all over the Midwest and South, but from the November crop report to the January crop report, The USDA lowered the average yield in Iowa by 2 bushels the acre, in Nebraska by 6 bushels an acre, Minnesota 9 bushels an acre, Indiana 11 bushels an acre. But just take a look at these numbers, and I can tell you, everybody in the trade would say, how could they have been so wrong in November? And be honest, I don't think anybody has an answer to that, but they were really wrong. And where we were looking at huge surpluses before, we're now still looking at surpluses, but not near as dramatic as what we had back then. Then we take a look at our export commitments. Yeah, we're well above the 5-year average, well above where we were a year ago. I mean, this is all good news, but this is the kind of news that caused the rally from last September up until last week. And that it was all built in the market. Here's how important Mexico is on corn exports. Here's where we are right now. A year ago, 2 years ago, China is not buying a flipping thing. They're out of the market. And Japan, Canada really does not buy corn from us. In fact, if you go to livestock producers up in, say, upstate New York, who several of which we work with, I mean, we frequently are importing corn from Ontario. It's cheaper to do that a lot of times than it is to bring it in by train from Michigan and Ohio and Indiana. And so Canada doesn't buy corn from us. We take a look at ethanol production being quite strong. The industry is doing very well. We take a look at ending stocks as a graphic representation. Yeah, we have a lot of corn, but you compare the last 10 years, we're kind of in the middle of the range. We take at world stocks, we've got a lot, but it's the lowest level we've been now in 8 years. So if you look at the world demand, supply demand, you can build a bullish picture here. And a lot of people are trying to do that, because what will happen is we get the stocks to usage ratio at this level, then any kind of a weather production problem here or in South America will likely result in a sharp rally in prices. But we believe that's going to happen from a much lower price level, because we are literally in the corn market in a collapse phase right now. Share of corn stocks, China has a lot of it. And this shows you their stocks is always extremely high. You know, this is for obviously for national security. I hate to say it, in case we go to war, they want to make sure they can feed their livestock and their people. They've always stored a lot of corn. We take a look at Brazil fundamentals. Their production is up substantially from 4 years ago. Their exports are up substantially, and their consumption is up substantially. Here's the real killer in the corn market right now. It's always important to look at who the players are that are holding futures and options contracts. This is a chart of the index funds. These are commodity funds that are long only. And a lot of investors will go in there. If they're bullish corn, go into an index fund, you know they're going to be long corn. Here's where they were in the top of the market in 2022. Extremely large long position. They're now at tied this record high position. This was as of last week. Very dangerous. Then you take a look at the regular long commodity funds, the long spec funds. They are also near the longest position they've ever had. And yet you take a look at commercial companies, which is this line right now, they have the biggest short they've had on in many years. So as this market went up from say last September, October into a week ago, the commercial companies, the Cargills and ADMs of the world were selling into it. The speculators were buying it. This is a very dangerous situation. It's like a rubber band that's ready to snap, because when this market turns, which has just started last Friday, this group will not hesitate. Once the trend turns, they're just going to fall over themselves, getting out of the market. And that's what's been happening all week this week. And people can't explain it, yet we think it's very easy to explain, because this is being driven by this group right here, trying to get out of the market where they had previously made a lot of money and now they're not. You look at the monthly chart of corn, it's rallied right back up to its long-term resistance. But then we take a look at a July corn chart. This is up to date through 2 days ago. As of 10 minutes ago, it was right here. And so we have lost, well, corn is down 13 today. I have live quotes here. This is absolutely devastating to a lot of farmers right now if they haven't already sold it. It's going to be very negative. Obviously, it's a very big positive for feed buyers, more of the companies that we work with. This is very good for a pork producer, very good for a poultry company. They're going to be buying their feed a lot cheaper. We don't think this move is over. There's December corn, the same thing. Take a quick look at the soybean complex. Production acres last year, 87.1. We're looking at 83.5 this year. Production is going to be down a lot. We think the carryover is going to decline. We are not near as negative on soybean prices as we are in corn. The soybean market is holding in very well in light of what the corn market was doing. For example, today, corn down 13, beans down 3. That's a win for the soybean complex. Take a, who's raising the beans. We're at 118.8 million metric tons, and look at Brazil, 169. Just absolutely no comparison anymore. And I'll show you in the world ending stocks. Again, China keeps large supplies. We take a look at the change in yield by state in the January crop report. Again, USDA dropped the yields substantially. Here's where we are in the export market. We're below the 5-year average, but we're slightly above where we were a year ago. It's still not a very good number. Where is it going? China still buys our beans, just not as much as we would like. Mexico buys some. Canada, again, they don't really buy our soybeans. I like this graph better than any, showing what's happened in the world fundamentals. As you can tell, you go back 10 years ago, Brazil was all the way down here about 80 million metric tons. Now they're over 160. It's hard to believe you could double production in 10 years' time, but that's what has happened. Their exports are at a record, and their consumption is also at a record level. When we take a look at China, their consumption is at a record level. Their imports at a record level. Unfortunately, even though they're buying some from us, most of it's coming from Brazil. U.S. ending stocks are rallying. World ending stocks that are an all-time new high. And again, a big share of that is in China. We take a look at the commitment of traders report that I just explained in corn. This one's altogether different. Here on the top line, black line, this is your large speculative funds. They're long, actually they're short 34,000 contracts. Commodity funds are short, or commercials are short 84,000 contracts. And it doesn't show in here, but the net position on the long side is held by small speculators. We take a look at a monthly bean chart, came right back down to its long-term support. If you're a technical trader in beans, frankly, you have mixed emotions on this. We're not convicted heavily to either the long or short side of this market. The fundamentals indicate the market is priced about where it should be. We think soybean meal is cheap, soybean oil is high. For livestock feeders, we want to be buying meal at this level. Not that it's going to go up a lot, but we think it's probably done going down. November beans, same thing. Here's your meal chart. We believe it's just putting in a base. And again, with the crush being so large, it's hard to believe that this market has much upside potential in it. But at the same time, the downside risk in meal is limited. Let me just make a few comments on the pork industry and the cattle industry, and then if we got time, we can do some Q&A. On meat production, poultry is at an all-time new high. Pork production is going to be up 2.47% this year. Beef production, as everyone is well aware, we're down again this year, down 1.6%. We take a look at a per capita consumption. Average American now eats almost 120 pounds of poultry per year. Beef has been relatively steady to down. We eat about 60 pounds, a little less than that, 59 pounds per person. Pork has been flat my entire life. We eat 50 pounds of pork per year, no matter what the price of bacon is. If we're a bacon eater and we eat 3 slices a day, if it gets more expensive, we don't cut back to 2. If it gets cheaper, we don't add to 4. We just eat 3 slices a day. It never changes. This is the one that's a little concerning. And long-term for beef prices, all cattle and calf inventory right now is the lowest it's been since 1952. That is pretty incredible. We take a look at a slaughter weight, though, what feedlots are doing to take advantage of the high prices that we've had. You notice the average slaughter weight now is about 1,440 pounds per steer, whereas the 5-year average is at 1,390. That's a big difference. So you can make up, if you have fewer heads coming to slaughter, you can make up a lot by just feeding the cattle longer. We take a look at the ratio, though, of feeder cattle to fat cattle. We're at an all-time high right now. And I point this out because historically, when we get to this kind of a spread relationship, it causes problems and the market comes down. This market has already risen a lot. Here's where we were in 2020 for fat cattle prices. We were down almost to $80, and now we were up well over, what is that, 180, 190. Been a big move. And here's your April cattle chart up to date through yesterday. We believe the cattle market is already topped short term, but we're not all that bearish. We have put options on for the cattle sellers we recommend, but I would not want to be short futures. Same thing in feeder cattle. Real big changes taking place here, though, in hogs. Here's your hog weights, about the same as they were on the 5-year average. What's important to recognize in pork, if we get into a trade war, how much of our pork exports go to Mexico. They are a major player. China, we talk about it, but this goes back to 2019 to 2021 when they had bird flu or some pork disease over there. I mean, they had to depopulate a big part of their pork production. And so we exported a lot of pork to them. But now we're exporting very, very little to them. Our pork exports primarily are going to Mexico. So a trade war with Mexico could be detrimental to the pork industry. And we are concerned, as many other people are too. We take a look at April hogs. This is up to date through yesterday. They actually collapsed today, similar to corn. And I believe this is probably a lot due to concerns over a trade war with Mexico because they are such a big buyer. And so right now, this is not a favorable situation for the pork industry. That's all I have, Sarah. So if we've got any Q&A up here, I don't know that I can read them myself.
Well, we can get to so if with the tariffs that are going in place or have been talked about, do you see more and more grain buyers then going to Brazil? And you already said they have a major share, but do you see that continuing, or is Brazil tapped out? Where are you at on that?
They're not tapped out, and I think some of those purchases will come back to us. But right now, it's cheaper to buy it out of Brazil, both corn and soybeans, because of the value of the Brazilian currency. So that's not going to change dramatically. And, the corn, soybean farmers and the cotton producers are all concerned about exports, and rightfully so, because Brazil's also ramped up cotton production quite a bit. And they've got the resources to do it. And I don't know, it's going to be very difficult for us to dig ourselves out of this hole. And, but at the same time, I think we're going to look more and more at our domestic demand, both on the feed side and on the ethanol side for corn, because we can't buy our way back into that market. It's shifted so much. So most we can hope for right now is that Brazil's exports start to flatten off, which right now they haven't done so. And I do think that this is going to be short term with the U.S. farmer. One of the leading weather forecasters that we follow, we had on our program here last week, he built a pretty compelling argument for the concerns of a severe drought in the Midwest this coming winter. Now, I don't ever want to bet a marketing plan on the fact that it might not rain, because what if it does? But this guy is really quite good, and he built a compelling argument. And supplies, while they're large, they're tight enough that any kind of a weather problem here is going to cause a sharp rally in the corn. Right now, and I know a lot of people don't like this is being pushed down by the commodity funds. They were long. They're the reasons we got so high, frankly. And we wouldn't have been where we were a week ago without the commodity funds. But when this tide turns, they can't wait to get out of this market. And that's where all the selling is coming from right now.
What about other options for Mexico for pork? Are there other options? Can they go elsewhere?
Well, of course, they could. I mean, there are some exports that come out of South America, but reality is no. I mean, they have it from us. This is why I think in the long term, this is still going to work out. We need them and they need us. I mean, let's get to the basics of economics here. And Canada needs us and we need Canada. And so, I think this is typical Trump negotiating. Let's try and scare everybody. And so we can then sit down and negotiate terms. I mean, he's done this all his life. And, I think in the long term, that will turn out positive. But in the short term, it's got a lot of people really scared. And, we'll get through this. And, Trump still needs the farm vote. I mean, I can't imagine he's going to let this just go to heck. But then he's also pumping $42.5 billion into the farm economy. And so, it's farmers are going to get through this okay. And the real difference is going to be between those who did not know how to market or did a very poor job of marketing, as we're looking at income streams of a difference of $250 an acre in corn production this year between those who did well and those who didn't. And so we're seeing some huge separations, and it's going to be interesting. We're going to see the biggest, I think, acceleration in farm size, row crop production this year we've seen since 1986, 87. We're looking at a lot of people exiting. There are more farm equipment auctions going on since January 1 than I've ever seen in my life. And a lot of producers are saying, I've had it. I'm rolling through. There's a huge one going on this week, or starting tomorrow, just east of Indianapolis, Indiana. And I looked at the bid sheet on it last night. I mean, a lot of big equipment that's being sold on consignment. So, we're seeing just some big changes take place. So, the reality is, okay, for those that are selling, this is not a good opportunity. But for farmers who've done well the last 2 years, this is an opportunity of a lifetime. And so we're going to see a lot of people expand, I think, significantly here in the next 6 months, not next 6 years. Next 6 months, we're going to see some very big changes. So it's an exciting time. We're seeing the same thing in the farm equipment business, huge contraction, and also in the seed and ag chemical business. And it's unfortunate, but that's the reality of life right now.
What about the food policies under the Trump administration? Does that have any of the commodity groups a little concerned? There's kind of a whole new focus in some areas.
I'm sure it does have some of them concerned, but I don't. So far, I don't think we know enough to really get upset. It was interesting watching the news this morning. Steak and Shake. I'm sure some of your viewers saw the announcement. Steak and Shake is switching from vegetable oils on their fries to beef tallow. And I mean, that's a real shocker. I mean, because it gives the French fries a better flavor, blah blah blah. And so if people eat fries, and everybody always thought it was healthier to be using the vegetable oils. I think, I'm not a food scientist, I don't know which is which, but I know that was a big argument. And right now they're switching to beef tallow for all Steak and Shake. Now, this is not a huge chain, but nevertheless, it's beginning. And our new Secretary of Health is really behind that, Kennedy. And so, we're going to see some changes like that, some different mixtures. But most food companies are not going to be quick to change because it changes the taste. It's just like the potato chip industry. You can't switch from corn oil to soybean oil in potato chips because it changes the taste a lot. And so there are going to be some people upset. No question. There always are when changes are taking place. But normally we get upset over nothing.
We just did a podcast on looking at genetic engineering in the pork industry, and they did some research on where consumers might be concerned and what their number one priority is. And their number one priority is, how's it going to taste? How's that pork going to taste from that genetically modified, not genetically modified, genetically engineered pig? So that was kind of interesting. Taste kind of always rises to the top, right?
As though we haven't eaten a genetically engineered pig for years. I mean.
Very good. Any final comments to leave us with, Richard?
No, I think, whenever markets get volatile, it creates opportunities. I mean, you just have to look at where, for a lot of people, they just get afraid and get upset. But these are the markets that where opportunities are made, and we're going to see some of the successful companies, successful feed companies, and successful farmers really thrive over the next 6 months. And it's just identifying where those opportunities are going to be.
So Richard is on the program. I think I heard you say at the Mid-South, is it Gin Show this weekend?
Yeah, Cotton Ginner Show, right? It's a
Cotton
big one.
Dinner Show. And then if you're going to the American Feed Industry Association Purchasing and Ingredient Supplier Conference here in Orlando in March, Richard's on the program there. I think you're on the last day on the 20th, if that's
That sounds
correct.
Yeah.
So yeah, we'll see you there, Richard. Thank you so much for your time and you sharing your insight with us today.
Thanks for having me. Have a good week.
And thank you all for joining us as well. We appreciate you tuning in. Until next time, for Feedstuffs 365, I'm Sarah Muirhead.